Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boyceno with my co-host Kevin Casey. Today we are joined by the ever enchanting Rob Chrisman. How are you, Rob?
I thought it was
Ever
ever
enchanting, apparently.
Yes,
delightful.
Rob Chrisman of the Chrisman Commentary, which you should be reading daily to get all your latest news and jokes. And jokes. Do you have a favorite joke, Rob?
A favorite joke, Audrey. 6 days a week, 52 weeks a year, for years and years. I have like jokes that don't repeat, except for my Cinco de Mayo joke, which is coming up in a month and a half.
Yeah,
Um,
that's Kevin's birthday, just so you know.
Yeah, just so you know, that's my birthday. That's why it's a holiday.
Right. That makes sense.
wow.
Yeah, exactly. Okay, a couple things. So this week, as always, it's very busy. We have tomorrow GDP Q1 final. We have mortgage applications, durable goods orders. Thursday, we have Q4 GDP final reading, initial jobless claims and pending home sales. And then Friday, we have the ever important, I can't even speak today, Fed's favorite measure of inflation, PCE, personal consumption expenditure. And there are all sorts of guesses on what PCE may or may not do on Friday. I, for one, choose to stay out of that conversation because it's anyone's guess. Rob, any comments on that?
I'm still digesting CoreLogic changing its name to Cotality.
Shut up. I
Really?
missed that.
Totality.
I missed that. We have Dr. Selma Hepp on next week, their chief economist. I will look forward to a little traipse through the name change. What?
You could come up with all kinds of questions to ask Selma about her Cotality.
I didn't even know there what that. Do I have a cotality? Do you have a cotality? I mean,
I know that I don't, so maybe anyway. So yeah, Cotality. Whoever
Totality.
wow.
whoever came up with that probably came up with the name Zactus, right?
Well, I'm like, okay, so of all the things to like address in a business, I mean, okay, I'm just gonna let it go because we do have her coming next week, and I don't want to completely, alienate anyone. But before we launch into everything else, just a little note that on May 15th, Greater Ventura Camp is having their annual lender fair, and it's really great. I mean, we have a ball. We go. It's really wonderful. They do a great job and they're working on some speakers. So it'll be interesting to see what that ends up looking like. And we hope to see you there, or I hope to see you there. I don't know if Kevin's going. Anyway,
I
so
don't know. They didn't invite me to be a speaker, so I'm not sure.
I think
Ventura's a cool place.
we invited
It's a
both,
great place.
I believe.
It's summertime.
Yes, I will be speaking, but yes. Anyway, okay, moving right along.
I
Kevin,
think you should get Cotality to sponsor this show.
don't even start. I don't even, okay, there's too many things to say about that. I would just like to say that Kevin was highlighted in an article in the San Francisco Chronicle talking about comicals. I literally, what is wrong with me today? Talking about condos. So, Kevin, there was also a Wall Street Journal article that was also talking about condos. Why don't you walk us through what he was looking for and that it's finally hitting the newspapers all these months later.
Well, we've only been talking about this for over a year now about condos being an issue for getting loans. And
Exactly.
so there was an article on what was it?
Doesn't matter.
I believe it was Wednesday in the Wall Street Journal, and there was a blacklist, according to them, um, of condos you couldn't lend on. And so then that article triggered the Chronicle to want to do a local article in the San Francisco Bay Area. And they reached out, of all things, to a commercial insurance broker friend of mine. And then he put them on to me. And then we were having an event, as we talked about in our event last week, that's for our camp chapter in San Francisco. And so I actually invited the reporter to the thing. He goes, it was just like mind blowing. The information was coming his way. And it was a lot of stuff for loan officers. I can't imagine what it's like for somebody who's not in the biz. But, we talked about all the issues that condos are having and how to get the HOAs approved with lenders that are not. We kind of went over that our conference is actually really interesting. We talked about for loan officers that every HOA is kind of like got 4 color codes. There's a green, which is great and send them the loans, right? And then there's red, like they're like Millennial Tower in San Francisco that was leaning at one point, and you couldn't get a loan on that from anybody other than private money. And then there's everything in between. Yellow and orange is kind of like yellow just means they didn't do their paperwork, and orange means they got to do a lot of work and get their stuff cleaned up. But they're not red, and you can get the loan.
So,
Anyhow, I digress. It was fun. It was fun. It was a nice article. I've been actually using it for marketing and just talking to realtors. And I've actually decided I'm just going to go after condos because no lender in their right mind would want to do condos right now. They're such a pain in the ass. It's twice as much work for half the pay.
that's the opposite approach as me, which I just tell my clients, buy a single family. What, Rob? Tell us.
Did the tower in San Francisco stop leaning? Did they halt that?
So here's the tower, right? And it was kind of like leaning to one way. And what they decided to do, and I'm not an engineer, although I did take some engineering courses in college. I said, what you have to do is you just have to tie this side into the bedrock and let the building keep leaning the other way. And then once it's straight, tie it in. Guess what they did? That's exactly what they did. So now it's straight and you can get a loan on it now, a conventional loan.
Thank you.
Yeah, you're welcome. I don't know how they got a, 72-story building to, go like this to this, but it's pretty impressive.
Attorney who worked on that at a party one night, and I had a lot of questions, and he didn't give me a lot of answers, and it was right as they were settling, and I'm like,
No, I talked to the contractor on that particular project. It was quite interesting.
Okay, with that being said, just to
All
know,
right.
California has gone from 170 condo associations on the naughty list in 2023 to 720 at this point. And Florida has 1,440 condos on the naughty list. And I just wanted to
1,400.
what?
1,400.
1,440. Yeah, that's people who
Do you know that in Florida you can have the HOA condemn the building without full 100% owner of all the tenants agreeing to it?
Yeah, that's a whole nother conversation.
Uh-huh.
But I wanted to make sure that we noted, and this is not a paid endorsement, Symmetry, who does HELOCs, does not require an HOA cert. So I thought that'd be interesting. So chew on that a little bit. So there is so much going on out there, Rob, as always, that I have a pile, and I'm hoping everyone's blocked out like the next 2.5 weeks because there's a lot to talk about. So let's start with home price appreciation. Let's start on a high note, shall we? In January, it was up. According to Case-Shiller, 4.1% from 4%. And FHFA was up 4.8% from 4.7%. That's year over year. So appreciation levels are really positive and doing well. Thank God. So, and especially, I don't know, it's still cold in other parts of the country in January, isn't it? And if that is, anyway, so you would think that that would be the slower part of the year, et cetera, but appreciation levels are holding, the values are holding up. Rob, what are you seeing out there? Anything other than that?
If you want to fine tune that a little bit, the upper end, San Francisco condos or Manhattan, the upper end is softer than anything less than 600,000 or 700,000, 800,000, which at this point constitute a starter home. So, some softness on the upper end. But yeah, the demand continues to be good, as we've talked about before on the show. Millions and millions of millennials scampering around, wanting to get out of their parents' rumpus rooms. And I saw a study this morning, I haven't read it yet, indicating that whoever makes these studies And I do kind of wonder who makes all these studies. How does anybody have time to work when they're answering survey questions? But the market, the existing housing stock is becoming overcrowded. If they look at the per capita bedroom use,
Oh,
it's like it's been creeping up. And so it continues to, not only do you have a total number of people who still want to own homes, but you also have homes where the population is increasing per house. And at some point they will want to move out. So yeah, I've been saying all along that the demographics just don't point to some kind of, you know, a dive in housing prices. I don't know why anybody would think that. And people say, oh, look at the FHA delinquencies creeping up. Oh, look at, the expense, the affordability is a problem. Homeowners insurance has been going up. HOA fees have been going up. People can't afford them, but people are finding a way. So I just don't see, and I would argue that 5% appreciation is so much better than say 20% that we were seeing,
Absolutely.
yeah,
yes.
during the pandemic. 5%, it's not, it's comfortable. It's not, it's not out of control. So
We're only
um
4.1.
or whatever, 3%, 4%, 5%, much better than 20 or 18 or whatever it was back then.
Yeah, I mean, anyone who's wishing for super low rates and incredibly high appreciation levels is clearly not remembering what we've gone through in the last 2.5 years, where we suffered the ramifications of all that. So things that are more moderate is much, much, much better. With that being said, they came out with existing home sales this past week for February. That was up 4.2% month over month, which was interesting because they were forecasting that existing home sales were going to be down 3% month over month. That's an annualized pace of 4.26 million units. We have in existing home sales, by the way, 1.24 million units, which is up 5.1% month over month. It's up 17% year over year. So we do have increasing inventory, but most of the areas other than those few sunshine states where a bunch of people moved to, we have inventory levels that are still below pre-pandemic levels. But overall, we're at 3.5 months supply versus the 4.6 month average or normal, and then 42 days on the market versus 38 days last year. So, Rob, I have a question about this 4.6 months supply. They always say that's normal, but we've been saying that's normal, but we're way, 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 way below that for so many years now. So who decided that's normal, and how does that do you have any idea about that?
I don't. Um, normal.
Normal.
I don't really pay a lot of attention to normal anymore.
Okay.
Um, it kind of is what it is at that moment in time. And when you talk about existing home sales or new home sales, you have to, and what, it goes down, it goes up. The more important thing, you just can't look at the headline. Folks on the call need to remind themselves that you really need to read at least the first couple paragraphs, 2 or 3 paragraphs of statistics like that, because our, existing home sales down. Well, is that because nobody wants to own a home? Is it because they can't afford to own a home and they want to own a home? What is the reason? Is there no inventory and that's why sales are down? So you have to look behind the numbers and figure out what's going on there. Like we were just talking about 3 minutes ago, I think the demand is there. The affordability continues to be a problem. As we've talked about on the show, it's almost as if you get loan officers get beat up over an eighth of a percent or something, or a quarter of a percent, and then you look at the homeowner, the homeowner's insurance. It's like $1,500 or $2,000 a month, and you're beating me up over an eighth in rate. Figure out your insurance situation before you come looking for a loan, or before you look for a property. So
We do that for
it's
them.
What's that?
We do that for them.
Well, that because you're a full value shop.
Yep.
Uh, but yeah, I mean, you talk about normal inventory levels. Well, inventory levels in, Las Vegas are probably different than inventories in Peoria, Illinois, different than Seattle, different than in Miami, different than, Asheville.
Yep.
And so it's very location, location, location. So you can't, you really have to take some of these nationwide statistics with a grain of salt.
I agree. I think though, when you're looking at things like inventory numbers that are true in all but 5 states out of 50, then it is something to actually acknowledge. I was listening to an NAR forecast, quarterly forecast, and they were saying that you really do need to look locally for what's going on in the market. I mean, we've been saying that for years, obviously.
All real estate is local.
The national statistics do matter to some extent, but you're 100% right about needing to look at things. You know, where do you live? Where are you doing your business? How does that apply to you? It'll be interesting also to just continue to watch the GDP numbers, because they keep revising those lower. So let's talk for a moment about the Fed meeting last week and the comments that came out of it, et cetera. So Jerome Powell, God bless him. I love him. I do. But he used the T word, transitory. And I was watching him speak, and I heard that number fall out of his mouth, and I could not believe my ears, because I don't know about the rest of the audience, but that's kind of a trigger word for me at this point. They forecasted transitory in inflation.
Yeah, I went into shock. I had to curl up into a closet for a while.
Oh my God, I still can't believe it. And then Austin Goolsbee like doubled down on it and made another comment. So he said, now, and this is something I want to talk about too. He pointed out that only 11% of our GDP comes from imports. And so he was saying that the impact of the tariffs will likely be, and again, transitory, brace yourself, kids. Sorry about that. So anyway, I just can't fathom why they would use that word again, how it doesn't hit
Well,
any the way it hits us, because I'm sure I'm not the only person. And what the hell?
Is there a question in there?
Yeah, what the hell?
yeah, what the hell? I can say it.
What the?
Well, what's transitory is a tariff that's there for 4 days. That's definitely transitory because it pops up and everyone kind of, okay, we just want to import stuff and it goes away. But what happens when it happens and now it stays there and then the market stays in that position for a long time and those pricing stick? That wouldn't be transitory.
So
Last week, we got an
I know.
from Elliot Eisenberg. You were here, Kevin. You should have heard it and hopefully remembered it. So we got a good explanation of what that meant, that one-time hit to the economy and inflation numbers. But it is hard to understand how, if you have something like oil, when Ontario was going to impose a 25% tariff on Northeastern oil, or the oil to the Northeast, how is that just a one-time hit? So anyway, talk about that, Rob.
I don't even know exactly where to start. I saw a headline today that Donald Trump is suggesting or offering or ordering or doing something regarding tariffs of 25% on any country that deals with Venezuelan oil.
Mhm.
The last time I listened to one of the Trump folks talking about tariffs, they were talking about fentanyl, how tariffs against Canada and Mexico were meant to stop fentanyl.
Yeah, except fentanyl doesn't come from Canada, but that's okay.
So you have a situation that may not be entirely economic. You have a president that's using it for punitive measures, and oftentimes, arguably, his own punitive measures. And so the economics of that sometimes aren't easily explained. I receive emails from people. I mean, this isn't a political show, but it's like, why are we picking on Canada? You know, they've been our longest, you know, they've been allies with us for hundreds of years, and yet we seem to be picking on them. And it's a complicated issue. When you talk about transitory tariffs, you know, perhaps President Trump changes his mind next week. April 2nd, everybody's talking about these tariffs that are going to be announced or put in place and so on. And I would think that it's not easy to put on a tariff. You also have companies who are out there stockpiling retail goods. You know, the
Yep.
Costco's of the world, the Walmarts of the good of the world, who import a fair amount of their merchandise. They've been buying up merchandise and stockpiling it ahead of the price going up. So
Mhm.
what impact does that have on things? And so
Well, you know they're
the
gonna raise the price the minute the tariff goes into effect, even though they have the items here already.
absolutely, absolutely. So what does that mean for folks on this call who are trying to help borrowers out there, who are trying to figure out what's going to happen, not so much predict interest rates, but figure out why interest rates are where they are and why is the bond market acting as jittery as it is because of these tariffs. And when the president announces tariffs and then a day later takes them off or says, you know, we're going to change that or we're going to make it goods specific, the market after a while, you know, doesn't know quite how to react
Mhm.
to some of this. But in general, traditionally, and tomorrow, right before this show, actually, I was writing tomorrow's opening paragraph, and there's a lot of information out there regarding tariffs. So I have a speech, you know, a short clip on a speech from President Reagan talking about why he was against tariffs. I've got Milton Friedman talking about why tariffs are not good. Paul
Mhm.
Krugman, the economist, talking about why tariffs are not good. But a lot of people find it very easy to understand tariffs, and um, it's a concrete action that can be taken to change the trade balance, to be punitive, to change a country's behavior.
Mhm.
And so I expect they'll be rolled out. But getting back to interest rates and borrowers and so forth, underlying what happens with interest rates, you have a borrower or a client who, if they're trying to figure this all out and they're trying to be comfortable and psychologically ready to buy a home for their
Mhm.
family, and interest rates are doing this and the market's doing that and the stock market goes way up and way down and so forth, it tends to cause nervousness among potential clients.
Yep.
And when your client is hunkering down because they don't know what's next, they're going to be less inclined to want to buy a home for $800,000.
Right.
So regardless of the economics, what's going on, the punitive measures of what's going on, the psychology can weigh down our our business, and that's not good.
Mhm.
No, the
Well, I
psych
know for
locking everyone in, the lock-in effect is they like to call it the last couple of years, but that's definitely easing up for sure. I mean, I just heard that 70% of the market is cash out refinances. So these are people who are finally to the point where they're saying, okay, I got to use this equity I have, even if I do have to give up my lower rate, which is opportunity for us. And then also, you know, the FHA delinquencies are an opportunity. Go check in with your borrowers and see if they need your help. Are they struggling and they just haven't reached out? I mean, so many times people wait until it's too late to ask
Yep.
for because they're embarrassed or for whatever reason, or they think it's going to correct itself and it doesn't. So these are all opportunities for us to be helpful and be professional and be an asset to our
Do-
borrowers and a reason to not push a button when you get a mortgage, right?
So, quick question. You said 70% of loan applications right now are cash out refinances.
70% of the market
Wow.
for refis.
So I do know tomorrow morning the MBA's numbers for last week applications will come out. I have heard, and I mentioned in the opening paragraph, that I've heard everybody's locks were up in the last week or two, so that's nice to see. It's causing some optimism out there. But I'm always interested because people are surprised when I tell them, look, the application data is running about 40 or 45% refis right now. The up and down and the applications number that are produced by the MBA, 40 or 45% of the volume coming through the door industry wide is refi. And granted, some chunk of that, maybe a third or 40%, is for remodeling costs. But a good chunk of it is because they've got 25 or 30% credit card debt.
Yep.
And yeah, we're going to give up our 2 3/4, 15-year fixed or whatever. Just because a skilled originator walks them through looking at their debt and looking at current mortgage rates and their existing mortgage rate and their equity and saying, you'd be better off doing this.
That's it. Again, looking for reasons to use an actual professional versus someone in a call center, somebody who's just an AI bot, whatever, trying to help you with your mortgage. We are going to look at it and we're going to look at the whole picture. And we're going to advise our clients as a professional, for God's sake. And I know I keep beating the drum on this, but it's really important because I hear a lot of talk from these guys. They're all about, oh, the tech, the tech, the tech. And there is often a disconnect between understanding that tech matters, but it requires a human to help implement it and use it the right way to help our borrowers really, and with the strategizing, et cetera. And then also the consumer confidence numbers continue to drop. So they are going down precipitously, say that 3 times fast, and are the weakest numbers since January of 2021. So the future expectations of the average consumer, and this was also reflected in University of Michigan's consumer sentiment, it's not good. They don't feel good about things. So get in there and communicate with them. Let them know how many options we have. I mean, it's so fantastic these days because, and we're going to talk about this in a few minutes, but we used to have very few options. You fit into the little conventional box or you didn't. You could get an FHA loan, you could get a VA loan, but really that's how most people thought, was this little tiny box. And now, I mean, you get some funky set of tax returns or somebody who is having a hard time with their validating their income. And God, we have a zillion options. That's a technical term, zillion. So anyway, we have so many ways to help people now, and it's nothing but opportunity, frankly. It's incredible, right? So, okay, let's go back. So the Fed meeting, I wanted your comments on this, Rob, because one of the things that Jerome Powell talked about was that they believe that the unemployment rate has stabilized, the labor market is solid, whether you're comparing U3 or U6 on the labor market, it's a totally different story, but they indicated that they're going to slow the runoff starting in April. So can you walk us through what they're planning to do, what has happened, what is going to happen, and how that impacts rates?
Well, without getting too much in the weeds. So folks on the call probably know, but I'll reiterate that mortgage rates, mortgage prices are a matter of supply and demand. We are in the business of manufacturing mortgages. If nobody wants to buy those mortgages, then we're not going to make those mortgages. Nobody wants to buy an Edsel, Ford stops making the Edsel. So during
for the people who don't know what an Edsel is, Rob, what is an Edsel?
That's his first car.
my first car was a 66 Mustang.
Oh, God.
Oh, nice.
It was
Audrey had
used.
the same one.
It was used. Edsel was a lemon, a car that Ford produced that nobody wanted. Now I'm sure they're quite collectible for whatever reason. But it was, if you are pick an item, if you make glasses, drinking glasses, and they're ugly or they have holes, and nobody wants those glasses, you're not going to make those glasses anymore. It's a money losing proposition. We manufacture mortgages. Those mortgages are typically put into mortgage-backed securities or they're put into portfolios. if you're making mortgages, they have to be saleable in the secondary market. Okay. So during
Also have to
2020,
be sellable to the clients too. It's a mixed world there.
that's true. That's true. 2020, 2021, one of the ways that the Federal Reserve, one of their tools was to go out and buy mortgage-backed securities that we were producing.
Mm-hmm.
When they would buy those mortgage-backed securities, they held on to them. When they would buy US Treasuries, they held on to them.
Mm-hmm.
Great. It raises the demand, raises the price, rates go down. Easy
Right.
peasy. Then the question comes after the pandemic goes away, what are we going to do with all these securities on our balance sheet? So you have the Federal Reserve sitting there. They're not in the business per se to own securities. They're in the business of stabilizing the economy. So you've got Treasury securities, you've got mortgage-backed securities. The question is, when a Treasury security pays off, let's say they have $1 million T note, T bill, comes due, a different wing of the government sends them $1 million. What do they do with that $1 million? Do they turn around and buy another Treasury security, or do they just squirrel the money away?
Pay down the US debt. That's what they should be doing.
Okay. With a mortgage-backed security, you have a different situation. You don't have to wait for the bond to mature. If you bought a 30-year mortgage-backed security 5 years ago, it's still got 25 years on it. The odds of that mortgage going to all 30 years until maturity are slim because people are refinancing.
Mm-hmm.
Somebody refis their $500,000 conventional conforming loan, and that mortgage is held in a mortgage-backed security that is owned by the Federal Reserve in their portfolio. What does the Federal Reserve do with that check for $500,000? Does it go out and buy another $500,000 mortgage-backed security or another $500,000 loan, or does it just once again squirrel it away? What does it do, or does it go out and buy a Treasury security? The Federal Reserve has different options. And so when you go back to the supply and demand of mortgages, when you have an increase in the supply of mortgages, locks pick up, applications pick up, investors notice that figure that comes out at 4 a.m. on Wednesday morning, Pacific time, and says, oh, applications are increasing, which means in 30 or 60 days or 90 days, the supply of mortgage-backed securities will increase. That might influence their thinking. If applications are going down, the opposite happens. Oh my gosh, applications are down. That means mortgage-backed security issuance 30 days, 60 days, 90 days from now will be down a little bit. And so they act accordingly. So with the Fed, who is holding trillions of dollars of various securities, the question is always, what is the Fed going to do with mortgage-backed security money that from loans that pay off early? And is it enough to move rates, or is what the Federal Reserve going to do? Are they going to go out and sell their holdings of mortgage-backed securities, drive down the price, drive up rates? That doesn't really help the stability of the U.S. economy. So this question about the Federal Reserve and what they do, what they may not do, and so forth. It's nice to hear Jerome Powell talk about what their plans are. Those plans could easily change, of course, but for now, I think the market is okay with the plan. So we'll see what happens. I think that people say, well, maybe the Federal Reserve should go out and should start buying mortgage-backed securities again. And what would that do? Once again, it would drive up the price and drive down rates. I don't know, as we talked about inventory 15 or 20 minutes ago. I don't know that mortgage rates are really the big culprit here when you talk about homeowners insurance, HOA fees, condo fees, and so forth. There are other factors that are factoring into the affordability crisis. And also, it's important for folks to remember the Federal Reserve isn't only looking at our our piece of the economy, the mortgage piece of the economy. They're looking at the whole economy. So for the Fed to step in and buy, let's say, mortgage-backed securities to try to drive down mortgage rates, well, I mean, that might help people, potential home buyers or people looking to refinance, but it may not help other parts of the economy. So the Federal Reserve, has a lot on its plate, and a lot of people don't like the job that Jerome Powell is doing, and I understand that. But I think given the amount of information that they have, or the Federal Reserve has, it's doing okay. We could easily sit here at these rate levels through the end of the year. People are
Mhm.
talking about one rate cut, maybe two cuts, but the
Mhm.
Federal Reserve is looking at the economy and saying, well, unemployment is what it is, and imports and exports, and the personal consumption expenditures and the CPI and so forth. They're looking at things, thinking things are relatively stable now and not so bad.
The Fed, when they came out with their statement, indicated that they are expecting two this year, but to your point, that can change on a dime depending on what
Just don't have to change anything.
happens next. They keep saying that they're data driven. They're going to continue to look at the data. And so the reports they're seeing out of various agencies are showing that the economy is fine. Everything's fine. It's the anecdotal surveys, people are saying, businesses are saying they don't feel good. They don't feel optimistic. What is wrong with me? Good grief. Anyway, so it is don't answer that. Both of you. I can see it, especially you, Rob, not one word. Anyway, so it is yeah, it is going to be interesting always. It's always interesting. That's the bottom line. Always interesting. There's always so much going on, so much to digest, but I'm not seeing huge swings in rates, like things that are making people go, "Oh, I'm
Pretty stable.
not going to buy now." I did have a client say, I'm not sure if I'm going to have a job. I need to wait and see if it feels more secure. I have heard that, but I'm not,
Was that Kevin?
that was not
Yeah.
Kevin.
No.
That was, but I thought that was interesting because that was the first time I'd heard that in quite some time. So
I've been hearing that a lot lately, actually.
are you?
Yeah.
Yeah. That's what you got to watch out for. Rob?
Hey, I have a question.
One? Okay, go.
My turn to ask a question. That just popped into my head. Audrey, if you're going to go buy a home and get a loan, can can you do your own loan?
No.
No. Okay.
No.
You know why? Because
What's that?
loan officers know too much stuff. Therefore, they can't do their own loan.
You mean they
Yeah.
know? Is that what you're saying, Kevin?
They what? I didn't hear what you said, Audrey.
Because they know how to cheat? Is that why?
I never accuse a loan officer of cheating.
I never said that. I'm asking why, because that doesn't make sense. They know too much. I mean,
They know too much, so that's too easy for them to cheat.
the last time
That's the logic.
I literally talked to my friend. I'm like, am I thinking this through right? Like, just making sure I was, but still, it's always good to have a little comparison or some perspective from someone else, right? Okay, so the Fed, they paused, they're holding steady.
Look at Heidi Williams chiming in. She did her own refi.
Well,
I wouldn't have admitted that online, Heidi.
well, I think maybe that, when was that recent? You could do that?
Yeah.
I mean, sometimes Kevin starts talking about something that happened 13 millennials ago, and I'm like, okay, is that
Well, I know, like with our company, it's against the rules. And I know before I was there, it was the same thing. I always had to get another loan officer to be the signer on my loan. But maybe if you are the broker, you can do it. But
All right.
I
I didn't mean to derail the conversation about global economics.
yeah.
I just thought it just popped into my head about what can a loan officer do their own loan?
okay? So Rob, you had a blip in your commentary I don't know when, about real estate commissions falling 0.17%, since 2023. So I thought that was interesting.
Yeah,
So,
'cause I'm not seeing that.
well, okay, first of all, let's start with, we had a bazillion-dollar settlement and we get a fractional decrease in average real estate commissions. Meanwhile, last week we had a conversation about how consumers were complaining that real estate commissions hadn't plunged, which, and then I saw another article this week where people who didn't use a realtor who was on MLS, they were getting less they were netting less on their transaction. And so this conversation is all over the place. But what are your thoughts on this? I mean, that settlement, was it worth it?
Frankly, I thought the world was going to come to an end.
No, you did not. You did not.
No, I didn't. Whether it was,
Oh, didn't it?
what's that?
Didn't it?
Huh. The creation of the CFPB, Dodd-Frank, the new 1003, TRID, LOCOMP, we continue to see these things that are going to be the end of the world, and they're not. And the National Association of Realtors, oh my gosh, a settlement, oh my gosh, what's going to happen? It'll freeze up the entire real estate industry in the United States. And what are we going to do? How can we advise our realtor friends? What can we do to help them? Which I understand, and I would tell them, don't ever offer your real estate agent legal advice. Please don't offer them legal advice. Second of all, I don't know where the realtors were when we were going through TRID, when we were going through the new 1003, when we were talking about LOCOMP. I don't remember the National Association of Realtors rushing to our rescue to do anything, frankly. Nothing against realtors. If I had a room full of realtors, I'd be telling them the same thing with a capital R, realtor. So the settlement happens, and I would tell people, you know what, they'll figure it out. They've got a lot of sharp people. They've got it's things aren't going to grind to a halt. They will figure it out, and
There was
they
a
figured it out,
there was
right?
a LinkedIn by a pretty prominent person in the mortgage business saying that it was so, what was the word he used? I mean, condescending was his gist, that that LOs were commiserating with realtors and saying, we understand, we went through this. And he's like, you don't understand, you can't. And I'm like, yeah, we can. It was just a huge change in what we thought was going to be the way we did business. And for us, I mean, it was for us. I mean, it kind of is for them too, but it felt monumental. And so to commiserate, I thought was appropriate. And look, you're going to get through this. We always land on our feet. I mean, those of us who are actually doing transactions, not the people who call themselves a profession and don't actually close anything. But with all that being said, it is a function of just keep your eye on the ball, keep going, keep focused on what do your borrowers need, how are you going to help them. And a lot of realtors are not having an issue with this at all because they're able to communicate their value, just like we need to communicate our value. What is our value? Why would somebody come to us versus going to a bot or a call center? And there are a zillion reasons, but you better know what they are, and you better be presenting those attributes to your borrowers so that they understand, right?
Exactly.
Exactly. Okay, I want to talk for a moment about okay, more than a moment. Fannie and Freddie. I literally have a list of many things about uh regarding Fannie and Freddie that I want to talk about. Let's start with, we discussed this briefly on our call.
Can I interject?
By all means.
I think before you go down the path, or as a foundation of the path, folks on the call should know that Fannie Mae and Freddie Mac throughout the decades since the 1930s, 1970, and so on, have had a huge impact on the primary market, i.e., you dealing with borrowers in terms of what the application looks like, the underwriting, DU and LP, and also in the secondary markets, because most product right now is going into Fannie Mae or Freddie Mac securities. or being sold to an aggregator like AmeriHome or PennyMac, who in turn issue Fannie Mae or Freddie Mac or uniform mortgage-backed security. And so the world looks at those two agencies and says, wow, because of Fannie Mae and Freddie Mac, they have 30-year mortgages in the United States, even though they were basically invented by the FHA. Fannie Mae and Freddie Mac have really promoted a 30-year fixed rate mortgage.
Right.
And
Unlike
so,
other countries.
what's that?
Unlike the rest of the world.
Yeah, go to Denmark, it's some kind of funky ARM product or whatever it might be. So Fannie Mae and Freddie Mac, what happens to them and what they say and what they do and what the government does to them does have implications for us as an industry. And not only Fannie Mae and Freddie Mac products, but also FHA keeps a close eye on and Ginnie Mae keep a close eye on what's going on with Fannie Mae and Freddie Mac. And also the non-QM world, looks at, because $100 of volume out of their pocket is probably $100 of additional volume in the non-QM world. And so you have non-QM keenly interested in what might happen there. They non-QM very interested in loan level. There's apparently some kind of rumor out there about the FHFA, shrinking Fannie Mae and Freddie Mac's footprint and actually lowering arbitrarily the maximum loan amount, which I don't see happening. But you know what? It's hard to say what may or may happen given the administration and given the new head of the FHFA and some of the things that he has done so far.
You could
with
easily
Fannie
get
Mae
rid
and
of the
Freddie
high
Mac.
loan limits.
Wow. Okay. So, okay, there's so much to talk about here. So let's start with, Bill Pulte, if you recognize that name, yep, it's that Bill Pulte, is the new head of FHFA, which oversee Fannie and Freddie, just to, again, make sure everyone's really clear what we're talking about. So he goes in and the first thing he does is fire half of the boards of Fannie and Freddie, dismiss the CEO and
COO and head of HR.
of Freddie.
Freddie.
He just threw it all up in the air, dismissed an a guy, somebody who had won a Nobel Prize in economics. I learned that in your commentary, Rob. And and then appointed a security guy from SpaceX who lasted one day because apparently he's Russian and has some Russian bank accounts and was concerned he wouldn't be able to stick with the scrutiny he was going to receive. So with all that being said, to say the least, it was a very interesting beginning. So, Rob, from there, then what happens?
Who knows, Audrey?
Come on, Rob.
Who knows what Bill might do tonight?
Yeah. Okay.
So it's a situation where anything goes. The administration, whether it's in mortgage banking or tariffs or whatever, is throwing a lot of things against the wall. The norms are no longer the norms. And we are back to a situation where, for better or worse, you wake up in the morning and you see what happened overnight with the administration. And, we have you don't know what's going on with, you may as well ask me what's going to happen with Greenland. I don't know. There's a delegation going there this weekend, apparently.
I'm curious.
Yeah, including the vice president's wife. So we'll see what happens. I don't know. So I mean, what?
Isn't she from Greenland?
I think she's from India, isn't she? I don't know. Anyway, so when you talk about Fannie and Freddie, unfortunately for home buyers that are out there, you have some family of four in some apartment and the landlord keeps jacking up the rent, and all they want to do is own a home with a white picket fence and a good school district, and they are subject to the whims of what might happen, and nobody knows what's going to happen. But Fannie Mae and Freddie Mac have a relatively clear mission, and that's to promote home ownership in the United States. That's one of their goals. And so I keep telling myself that we're they will continue to do that for better or for worse. So we'll
Well,
see.
do you think they will?
Sure, but at probably a different price than we're at now in terms of mortgage rates.
Okay, so we had a question from someone whether you thought they would merge Fannie Mae and Freddie Mac together. Do you think that will happen?
That's a good question. I
Crystal ball, get it
I
out. There we go. There's.
I could see that happening. But each one's a little bit different. I mean, you
Yeah.
guys, you know probably better than I do in terms of what's the differences are with a loan, why it might go to Fannie or Freddie, DU versus LP.
Uh-huh.
Uh, Fannie does this, Freddie does that. Certainly in the secondary market, they are combining Fannie Mae and Freddie Mac loans into one security,
Mm-hmm.
and the capital markets are comfortable with that combo platter. In terms of the primary markets, yeah, I could see that happening.
So there was another proposal which you and I talked about briefly that neither of us really knows much about. Treasury Secretary Scott Bessent, and this was posted on LinkedIn by James Kleinman. He said a newly created sovereign wealth fund could invest in the stock warrants held in the GSEs, most recently valued at 270 billion by the Congressional Budget Office. So there's been so much talk about releasing Fannie and Freddie from conservatorship. Every conversation that I have heard of late, all they talk about is it's good for the investors, but the prices are going up. The rates are going to go up. So it's not good for the consumer, it seems. I don't know. And it is just so, but again, this is way down the road. They're also saying that there is no way it's happening this year. It probably wouldn't even happen next year. It may happen. You know what I mean? So who knows? But watching all of this turmoil, and I mean, I didn't expect him to go in there and fire half the boards and get rid of, the Nobel winner and replace him with a SpaceX security guy. And I mean, from
Well,
Russia, I don't know. Like, I just try to figure it out. Like, and for me, Fannie and Freddie was so important during lockdown, the CARES Act. They were the only game in town. Every private jumbo went away, non-QM went away, everything went away except for the GSEs, right? And
right.
and so to think that we don't have that as a backstop is terrifying, honestly, should we have another crisis.
That same thing happened in 08. Remember?
But
Everything went away but Fannie Freddie.
it did. And so I was so convinced that they were so important. And now the way again, and this happened in the last administration, I mean, the LLPAs went through the roof. The focus became much more about the serving the underserved, which typically was done by FHA. So now we're double, doing that, which
Underserved being double served.
well, okay, but my biggest issue with it's not that I don't want to help everyone, because if you listen to me for 5 minutes, that's all I care about is helping everyone, right? But is it smart that they have removed all of the really, really high credit score borrowers from, I mean, I haven't done an investment property with the GSEs in years. I do them all non-QM. I check. I always check. I always make sure, and I make gosh darn sure my clients aren't about to move into that investment property down the road, which would violate most of the non-QM agreements. But the rates are so much better. It's so much easier. It's so much better not dealing with the GSEs if you don't have to. And so have they rendered themselves much less relevant?
So there are different ways, there are different things that can be done to enact change. The CFPB is a great example. You don't have to do away with the CFPB because I believe you need congressional approval to do away with something. You can just cut off the CFPB's funding.
So the CFP is
You could have the management of the CFPB change its attention to something else. The same thing can happen with Fannie Mae and Freddie Mac. You don't have to do away with Fannie Mae and Freddie Mac. You can shrink Fannie Mae and Freddie Mac. If you don't like Fannie Mae and Freddie Mac and think we should all go to private label securities, which I view as a huge mistake because we saw what happened in March of 2020 when
Yep.
the non-QM investors said, we're out. Then what?
In jumbo.
So
Hey, Steve,
you can lower their maximum loan amount. You can raise their minimum loan amount. You can make their loan level price adjustments so onerous that loan officers automatically gravitate towards Verus, Deep Haven, Angel Oak, Logan, eResi, any of the multitude of non-QM investors that are out there because their pricing is better or because their underwriting criteria don't, I mean, the non-QM investors underwriting criteria accept loans that the agencies don't. You can constrict the box, the underwriting box of the agencies and say, well, Fannie Mae and Freddie Mac are still in business. But when you go to look at sending a loan down that conventional conforming path, it may not make any sense. So they haven't done away with them, but they've
and it's like
shrunk
they've
the
done with high
footprint.
balance loans, Fannie and Freddie, the high balance programs, like they never seem to make sense. It's almost always cheaper just to go jumbo.
Yeah,
I
there
don't,
you go. There's an example.
I don't use balance. I don't use investment properties. I don't do a lot of second homes.
Second homes, yeah.
I every once in a while.
Condos are another issue.
So it's like, okay, what are we like? So frustrating because they should be important. They do matter, to your point, to
Yeah.
my.
Hey, Rob mentioned something just now that Audrey, you were going to talk about. Do you remember when he said that all these programs went away? March of 2020?
Ooh,
Rob, he just said that in March 2020, all these programs went away and all we had left was Fannie and Freddie.
I started with that, Kevin.
Oh, okay. Do you remember what happened right after that? We started the show.
Oh my God, I almost forgot
We've been
again.
doing this for 5 years, Rob, this week.
5 years.
Yeah, 5 years.
5 años.
We're on to our 6th week now, or 6th year.
51 weeks a year. Yeah. Crazy, crazy, crazy. And
And it
it's
hasn't stopped changing. The pace of stuff that was happening at that point slowed down a little bit, but it's still constant. The change is constant.
well, Kevin has blocked out that we were doing 2 or 3 webinars a week back then because it was so crazy. And so, yeah, it has definitely been quite a ride. We've learned so much. We are so happy that, we have people who have been watching ever since then and so many new ones. So anyway, so regardless of what happens with Fannie and Freddie, it is just, we're going to keep doing loans. We're going to find solutions. And I was talking to a non-QM guy the other day, and some of the non-QM lenders, and it's not just one, they are starting to embrace a Fannie, like a conventional sort of option that doesn't have the LLPAs, but the pricings. So the pricing's
Yeah,
better.
interesting. Because I ran into that just the loan I just closed a week and a half ago. I did a non-QM lender because I needed it done really quick and like was a super high important client. But then when I went to the signing, I noticed that they threw in, it was investment property, right? But it was a full doc loan. We didn't even do a rent survey. We just totally went off the client's own personal income for the loan. And yet they slipped in that document that said they will never, ever live in the property. I'm like, why can't they live in this property if they wanted to? They can afford it. They use their own personal income. They have total ability to do this. So I've been fighting with the lender saying that document should not have been in the closing papers. But I don't know what to do about that. I'd love to hear from anybody else in the market.
Go to your signings and read the docs. I just want to end on, I was in a realtor meeting and I heard about this California Assembly Bill 666 that would make Bigfoot the official state cryptid. And if you were wondering what a cryptid is, because I did, especially when it was associated with Bigfoot, it's a creature whose reported existence is unproven, often described in folklore or eyewitness accounts, and the subject of cryptozoology, the study of such creatures. So Just in
But
case,
keep in mind the number of that Assembly Bill
I
666.
did notice that. Yes, that was noted. So
Because I'm pretty sure we're in the 3000s in the Assembly Bills right now.
no. We're not interested in your facts or any of that. We're just, this is literally, it was, I think it was introduced as a joke, but I'm like, all right, there's our legislature at work. There you go.
Speaking of Assembly Bills, though, 3008 Assembly Bill, I believe it's Assembly Bill in California, made the misrepresentation of occupancy a felony beginning
I
January.
wrote about that.
Yeah.
Wrote about that.
We talked
I've
about
got I've
ago.
got grandparent duty.
All right, we are done. I can't believe it's at the top of the hour, just over. Rob, thank you so much. Smile big. You're going to go see your little granddaughter. And we thank you for being here today. And thank you to everyone. Go get a loan.